Hey everyone, Steve here and welcome back. Today we are staring down a pretty brutal dual collision on the tape. On one side we've got the sheer heavy gravity of a relentlessly hot CPI print, and on the exact opposite side we're dealing with boiling geopolitical risks in the Middle East that are literally threatening to sever global supply chains. Look, if you are long and leveraged right now, meaning you're heavily borrowed to bet on this market going up, you need to pay very close attention to what the data is screaming at us today, because the ground is shifting incredibly fast right under our feet.
All right, let's run through today's roadmap. We're going to cover the closing tape, the stagflation trap, that massive Strait of Hormuz risk, lay out the bull and bear scenarios, and wrap up by tracking exactly what the smart money is doing.
First up, part 1, the closing tape. Let's see how the market actually digested all this hot data.
So the bulls really desperately tried to hold the line at that 7,400 level on the S&P 500 today, but they just couldn't do it. We closed down over 1%. But honestly, Brent crude is the real truth teller today. It settled at a boiling $107.16. Energy traders are clearly not buying into any of these rumors about peace talks. Meanwhile, gold got rejected right at its highs, and Bitcoin, well, it's just clinging to support right above 80,000, totally failing to break out. The tape just doesn't lie, guys, and right now, it is absolutely screaming caution.
Moving on to part 2, the stagflation trap. This is the inflation collision we've been warning about.
3.8%. Seriously, just let that number sink in for a second. Headline inflation just hit 3.8% year over year. That's up from 3.3% in March. Economists were really praying for a cooling trend here, but I guess those prayers went straight to voicemail, right? We got a nasty spike instead, and energy costs accounted for over 40% of this entire monthly increase. It is a heavy, heavy number, and the broader market felt every single ounce of that weight today.
And here is where it becomes a truly toxic brew playing out in real time. You've got high inflation pushing that 3.8% level, crashing head-on into dismal non-farm productivity, which, remember, is the actual measurable output of workers, dropping to just 0.7%. So when you contrast rising, sticky costs against stalling human output, yeah, you can kiss any hopes of a pristine soft landing goodbye. This is just the basic, brutal math of a stagflationary spiral, plain and simple.
And then you see the 10-year Treasury yield pushing 4.5%. Man, that is a hard reality check. That 4.5% essentially acts as a strict valuation ceiling for the market. Think about it. When you can get that kind of risk-free return just by holding government debt, the sky-high price-to-earnings multiples on all these overvalued tech darlings, they absolutely have to come down. The oxygen is rapidly leaving the room for those plays.
All right, section 3, the Strait of Hormuz risk. This is what I call the digital power lever.
We've got to step away from domestic inflation for a minute and completely cut through the social media noise to look at the physical realities escalating overseas. Today, Tehran officially rejected the one-page memorandum, and instead, they fired back with a defiant 14-point ultimatum. The threats here have escalated significantly. They're threatening to target regional energy infrastructure, and crucially, this is the big one, they are threatening to sever undersea fiber optic cables if the naval blockade isn't lifted.
We also have to factor in the response from U.S. leadership here. Former President Donald Trump's stated response to Tehran's demands was simply, and I quote, totally unacceptable. This is absolutely critical because the established deadline to obliterate Iran's civil power grid and bridges expires tonight. This isn't just a theoretical exercise on a whiteboard anymore, folks. The clock is actively ticking down as we speak.
And this right here is exactly how a localized regional issue builds into an unprecedented systemic risk. That specific threat to the undersea cables, that elevates this whole situation from a regional oil bottleneck into a direct physical attack on the global financial data stream. If those fiber optic lines are cut, the data flow that powers global markets goes dark. It is quite literally a digital power lever being pulled in real time, right in front of us.
Section 4, Bull and Bear Scenarios. Let's size up the market sentiment going into tomorrow.
You really need to know what the massive institutional players are betting on heading into tomorrow's session. Now, the bullish view is basically banking on what they're calling the Beijing miracle. The idea is a scheduled visit forces a sudden diplomatic breakthrough, the strait opens up, the S&P rallies to $7,500, and oil retreats back to $85. But on the flip side, the bearish reality is the stagflation trap. If that hot CPI and the expired deadline result in military resumption tonight, the power plants go dark, and if that happens, $100 oil is history, and we are staring right down the barrel of $150 Brent crude by Friday. It's a remarkably stark, binary outcome.
And this setup perfectly illustrates that exact bearish momentum. The aggressive, steepening posture of the energy market is just undeniable right now. We are seeing higher highs and higher lows decisively breaking out of consolidation. The market is clearly pricing in severe risk, and looking at these technicals, a $150 barrel is a very realistic threat if diplomacy totally fails tonight.
Finally, Section 5, following the smart money. Let's get down to the actual directive.
For the S&P 500 tomorrow, you absolutely must watch the 7,300 floor. We already closed well below the 7,400 level today. If the index fails to hold that 7,300 line on the open tomorrow, the melt-up, that rapid, euphoric asset inflation we've been riding, is officially over, and the true correction is on. Listen to me. Do not try to catch a falling knife here. If that floor gives way, you step aside and let it drop.
If you want to know how to navigate this, follow the heavyweights. Melton Strategy over at Berkshire Hathaway is the perfect playbook right now. They are currently sitting on a record $397 billion in cash. Greg Abel just net sold $8.1 billion in stocks. He isn't sweating about missing out on some sudden miraculous rally. No, he is leveraging the risk-free rate, happily earning 5% on treasuries, and patiently waiting for the harsh reality of interest rates to sink all those over-leveraged boats.
So, here is your gritty mandate for tomorrow's opening bell. Small sizes, tight stops, entirely ignore the noise you're seeing on social media. Do not go chasing late entries in tech because the upside there is heavily, heavily capped right now. Stay perfectly disciplined and strictly protect your capital.
I'm going to leave you with this to chew on tonight. With the 10-year pushing 4.5%, which is crushing multiples, and a literal geopolitical powder keg waiting to detonate in the Strait of Hormuz, is your portfolio actually prepared for a massive stagflationary correction? Take a hard look, assess your risk, and protect your capital. I will see you at the morning bell.